Okay, hi everybody, welcome to this trading setup channel, your one-stop place for strategies, indicator explanations, and just general knowledge on how to trade and how to get that profitability up. My name is Niku, and today we're going to be discussing divergence in trading. Divergence, and sometimes called convergence, has been around for ages. It's one of my absolute favorite strategies. I use this daily, and a lot of people seem to struggle with the idea, or rather struggle with the timing of divergence. So even though people quite often understand the concept, a lot of people, it seems, still struggle with getting the entries, knowing when to take the trades and when not to take the trades. And that's what we're going to be looking at today. We're going to see if we can pick up a few trades during this live stream as well, and I will be explaining as we go along. I will also really encourage you guys, if you have any questions, ask them in the chat. I'm reading them. I'll be answering as much as I can. If possible, let's stick to the divergence topic, but if there is something else, we can have a look at it. Also, I've got the guys that are with PO Broker, I've got a promo code for you guys later that you can use. It's for a 80% deposit bonus. So stick around. We've got that coming up, and yeah, and that works from as little as $10 deposits. So if you're using PO Broker and you do need to, and you want to take advantage of that, hang around, and we'll get to that in a few minutes as well. Okay, so let's get started, and let's head over to the charts, and we're gonna have a look at divergence. Okay, so the first thing first point I want to make is that divergence can be used on any time frame. You will find examples of divergence on everything from a 10-second chart up to a daily chart. And the thing about divergence is, whatever time frame you are looking at, you need to give a few candles to for the divergence to play out. I will never, for example, find divergence on a 1-minute chart and then do a 1-minute expiry trade. If I'm looking at 1-minute charts, I'll go for 5-minute expiry trades, or maybe a bit longer. If I'm looking at 10-second charts, I'll do a 1-minute expiry. So you always need to give a couple of candles at least for the divergence to play out. So that's point number one. That's one of the important things. Okay, so we get, there's 4 kinds of divergence, and technically it's 2 kinds of divergence and 2 kinds of convergence. What do we mean when we say divergence and convergence? It's a very simple concept. When 2 lines are running next to each other and then start drifting apart from each other, that we say those 2 lines are diverging. So that is what divergence is. And then convergence is exactly the opposite. When 2 lines are running parallel to each other and they start moving towards each other, that is convergence of those 2 lines. And we see that in the charts as well. We have instances where this takes place. So the 4 kinds of divergence is we get 2 normal types of divergence. And these are reversal signals. So if we get normal divergence, it tends to form at the end of a big move. Not always, but that's usually where you will find normal divergence. So you'll get a move, you'll get a move, either a bullish trend or a bearish trend, and then when price starts to turn and go change direction, you will quite often find that that change of direction was signaled by normal divergence. The other kind of divergence we get is hidden divergence. So hidden divergence is a continuation signal, And this we will usually find in a area where price started moving in a direction, and especially when this trend becomes well established and strong. Let's say you've got your momentum indicators is showing that there's a lot of momentum behind it, or your volume indicators are showing there's volume coming into the move. So as the move gets stronger, we will quite often see corrections forming in the trend. Now, a correction is just a short little pullback, and then where price pulls back a bit and then continues in the direction. That is a correction, and quite often these corrections will then the continuation will be signaled by a hidden divergence. So for normal divergence and hidden divergence, like I said, there's 4 kinds: 2 normal, 2 hidden. The normal ones are reversals signals, and the hidden ones are continuation signals. Now, people often tend to struggle a bit more with the hidden ones, to learn to spot them as they happen. It does take a little bit of practice, but once you get the hang of it, it's going to become one of your favorite signals that gives you entries. And like I said, it's one of my absolute favorites. I use it daily, and I think it's invaluable. So let's have a look at a few examples. I am on a 1 minute chart currently. Let's see if we can find 1 or 2 examples of divergence. There was quite a few this morning, and let me just scroll back here. Okay, so this was lovely examples. We were in a well-established downtrend here. In this area, let's draw the a trend line in here. Let me make this a little bit bigger. Okay, so we had price moving down in this direction here. Okay, so this was this area here was a let me put this like this. We were in basically in a kind of like a channel downwards. Let me just remove this auto scroll. Okay, so price was moving downwards here. I should maybe add before we go over this. You can use almost anything for to pick up divergence. My personal favorite is the stochastic and the RSI to find divergence, but you can use anything that oscillates, either around a set value or around a 0 point, or you can use anything that moves between 2 fixed points. Like the stochastic moves between 2 fixed points, a value of 0 and a value of 100, as does the RSI. You can also use the CCI, which pivots around the 0 line. So anything that oscillates, you can use. There's a lot of indicators available that you can use. You can even use like the MACD if that's one of the indicators you use for a different strategy. So if you're using anything you use that if you're using an indicator that oscillates for a different strategy, you don't need to add anything else. If you don't want to, if you maybe have a couple of indicators on your chart already, you don't need to add the stochastic if you don't have it, or you don't need to add the RSI. If you have something that oscillates, you can use that to pick up divergence as well. So I'm using the RSI and the stochastic today because these are my favorite, my 2 favorites. But there are people I know that prefers to use the CCI. I know there's people that use the MACD, for example. There's a bunch of other things you can use as well, as long as it oscillates. Okay, so let's have a look at what happened here. We were moving in a downwards direction, and this is a beautiful example of hidden divergence. Price made a new low here. Let's draw this in as well. Okay, so we know that the definition of a bearish trend is that price makes lower lows and lower highs. Okay, so when price behaves in this way, we know we're in a bearish trend. Opposite goes for a bullish trend: higher highs, higher lows. And price was making lower highs and lower lows from the top here and up until this area where it started turning. But this is the area we're interested, is this area right here. So this was a new low, sorry, a new high from that area there, and then price formed another lower high. If we look at the stochastic oscillator though, when price formed this first low here, let's draw it in like this. So we're looking at these two peaks here. When this peak was formed, the stochastic oscillator basically touched the 80 line and came down again. But when it formed the second peak, which is much lower than the first one, my stochastic oscillator made a higher high than the previous high. Okay, so this is hidden divergence. It looks exactly opposite. It's exactly the opposite if we're moving in a downwards, in a bullish move. It will be the opposite. Easy way to remember, a lot of people often tell me that they get confused whether they should watch the highs or the lows. A very easy way to remember it is that if price is moving in a direction, it's going to be it's pushed down. Okay, so the pressure is coming from the top, from above. That's more clearly. So that's why we see the corrections. When price is moving downwards, we see corrections coming up and it's being pushed down. When price is moving upwards, it's being lifted up. So when we look for divergence, especially for hidden divergence, if we're looking for divergence, we look on the top side. If price is moving downwards, we look at the peaks because price is being pushed downwards. And when price is in a bullish movement, we look at the lows because price is being pushed upwards. That's an easy way to remember it. I will not look at the, if price is in a downwards direction, I will not try to find hidden divergence. The lows are basically irrelevant for hidden divergence. So because it's a continuation, we're going in the direction of that the price is being pushed. For normal divergence, it's the opposite. So for normal divergence, then we will look, when price is moving in a downwards direction, we will look at the lows. And then when price is moving upwards, for normal divergence, then we'll look at the highs. Okay. Binary Trader said, good day. Good afternoon, mate. Welcome. Any questions, please feel free to ask. Okay, yes. So those are the kinds of the divergence that we use. Now the big question is, how do we put this into practice? So what we're going to do is look for a few trades and see if we can find some divergence form. This is actually, this was a beautiful bullish divergence example, hidden divergence. If we look at the lows that formed here, especially this is the last clear low that we had. This was price was started moving upwards, came down all the way and got pushed back. If we look at the low here, when this was formed and we look at this low that was formed here, we can see that my stochastic oscillator made a lower low while price made a higher low. That's divergence and it's hidden bullish. So this would have been a buy area for me. When do I take this? This one was a bit tricky because of the massive movement. The ideal area to take this will be, this is the reason why I love the stochastic so much. My ideal time to take this, I'm actually going to take this trade. Let's go with 3 minutes. So the ideal time for me to take this is when my stochastic crosses over. That's a very easy way to see when to get into a trade. So I might be a bit late on this one. Like I said, it's not too clear because of the big candle that formed, that came down and it shot back almost immediately. But this should be fine. We should see some more pushing upwards. Let's switch. We're not going to get a lot of examples. If we look at a 1 second chart, we're not going to get a lot of examples. A 1 minute chart, we're not going to get a lot of examples. But while we wait for this to finish, let's just switch over to a 1 hour chart. And we can see we should be able to pick up divergence quite quickly. Some examples at least. Okay, so there was an example of normal normal bullish divergence. If you look at the this area here, so price made a higher high here, but my stochastic did not. So you could take a sell here when the stochastic crossed. You can take a sell for a few candles, and then it would have been it did pull back. So divergence can be picked up on any time frame. I use this on long-term trades as well. This is going beautifully. Let's go back to 1 minute. Okay, so this is running beautifully. We've got a minute left. I really doubt that it'll come back down all the way. But this was a really beautiful example of hidden divergence. So hidden divergence, always remember, hidden divergence goes with the trend, and normal divergence signals a reversal in the trend. So this would be, this was hidden, and yeah, this should be good. It shouldn't come down before our time runs out. But I'm going to switch to a 10-second chart and just see, because the 10 seconds moves a bit faster, we should get a few more examples while we're doing the stream. I really want to maximize the amount of trading we do. But let's see if we can find, there was a beautiful hidden divergence here. Okay, we can see price made a higher high from this previous drop in the stochastic. So, and the stochastic made a lower low, higher low versus lower low. Okay, that trade was good. It won. Okay, so here was a buy. This was a buy opportunity for us, and I really recommend, guys, if you want to use this, try it first on demo. Please don't just jump in. This does take a little bit of getting used to. I've seen people usually take a week or two to really get the hang of divergence. There's also a lot of information on divergence online. If you just head on over to Google, there's a lot of places that will explain divergence. If you don't, if you're struggling with the concept, you'll be able to find a ton of examples as well. But just make sure you really understand it before you really apply it on a live account. Okay, speaking of live accounts, Divergence 80 is the code for today. So those of you that trades with PO Broker, you can use that code for an 80% deposit bonus. Okay, so where were we? Please practice something like this first. Very often I see people pick up a new strategy, something that they're not familiar with, and they just jump in. They jump in with it on a live account because oftentimes people think they understand it, but they miss some of the details, or they don't end up not really understanding it, and then end up losing money. And then they throw the strategy away because they lost money with it, and they will never think about using it again. Where the real problem was that they didn't understand what they were doing, and this usually turns into the cycle of always looking for new strategies and always losing money and always throwing away often decent strategies simply because it wasn't practiced or it wasn't understood properly. You need to remember, trading is a skill you need to learn, and any skill we need to learn, or any new skills, must be practiced. Doesn't matter if it's trading, welding for that matter, whatever you do in life. If it's something new you're learning, especially if it's complicated, you do need to practice. I know it sounds obvious, but a lot of people simply don't do this. They skip these steps. and they just rush in, and it's really always a bad idea. Okay, so it's a skill we need to practice. We need to refine the skill, and this will take time. This will take some effort. It doesn't come by itself. So it's very crucial we remember, please, anything you learn anywhere, please test it and practice it before you apply it with real money. Because, like I said, oftentimes if you don't understand it, you're just going to end up losing money. Okay, divergence is really not a very difficult concept. And once it clicks in your head, it will be with you forever and you will always be using it. It's been around, I think they've started using this in the 60s or 70s already. People were using this widespread. So it's not a new thing, it's not a secret thing, it is there. It just needs to be understood and practiced. Okay, so I was hoping we're going to get some hidden divergence here, but from this previous high here, price is making a lower high, and my oscillators is making, both my RSI and my stochastic is also making lower highs. So this is not a hidden divergence for me here, unfortunately. But I'm sure we'll pick up another trade or two. This is a patient game, or a game of patience. I'm gonna see if, I just want to have a look and see if we can find some normal divergence examples, even if it's on 10 seconds. Just so I can show you guys the different types of divergence we get. I saw a beautiful example earlier this morning. It was normal bullish divergence. It was such a beautiful trade. I think it was somewhere here. Let's see if we can find it. There we go. Okay. So this is a very, very nice normal bullish divergence example. Remember I said normal divergence signals a change in the trend usually. So when price has been moving in a certain direction, we know we can start looking for either hidden divergence as a continuation or normal divergence as a reversal. And so what happened here is price was moving downwards, and we can see that the stochastic oscillator was stuck in the oversold area the whole time. But here's the thing. It was running at levels that's like 1% and 2%. So it was like really like maxing out the oversold area. But here we had an interesting thing that happened. Price made a low, pushed back, and then made a new low. Okay, so this low is lower than that one. Although it's faint, it's there. But in this little correction, my stochastic actually came back and it went over the halfway line. Right, so it pushed back quite a bit for the first time in this downwards trend. It came back up, and then it dropped again. As price made that last push downwards, my stochastic picked up. But this low that formed on the new low here was much higher than the previous low that we had. And we can see exactly the same thing on the RSI as well. Exactly the same thing. And this is a buy signal. Okay, so this is where this was a buy for me. And it was a good trade. On the 10 seconds, this was a 1 minute trade. And this is what bullish divergence where you will usually find it, when price is moving strongly in a direction. If price is ranging, oftentimes it happens that price gets caught between two levels, and it will just keep bouncing between those two levels. Don't even look for divergence in those areas. Okay, so when price is ranging, we don't use divergence. We only use divergence when price is moving in a direction, because the divergence signals one of two things: continuation or reversal, and there will not be continuation or reversal in a range. Okay, so there's other ways to train that, to trade ranges. We use other strategies and indicators for that, but purely divergence, we're not going to look, once you realize price is caught in a range, don't attempt to look for divergence, because you will, if price is caught in a range, it's going to be volatile. It's usually more volatile than when it's trending. So it's much more riskier to look for divergence and stuff like that. We really want to price to be moving in a direction. It doesn't always have to look like this though. Okay, so this is a very strong downwards push. But even, I mean, like this isn't a range. None of this is really ranging. We've got price coming down, going up, coming down, going up. So when it's moving like this is not a range. So we can look for divergence in areas like this. But we, like in this area here, when it's flat like this, this will not, once price starts behaving like this, I stop looking for divergence, and then I wait for price to start moving again in a direction. Okay, so you're not going to get a trade every minute or every 5 minutes if you're using divergence. You will have to be a little bit patient. Okay, so divergence will form. Some days it forms often, some days not. There's no way to say that I can tell you you will get this many trades per hour or something. But divergence will always be in the charts. There will always be divergence. Whether it's plentiful today or scarce tomorrow, it will always be there. So it's something that we can use consistently. And divergence, if used properly, if you time your entries and you wait for the good setups, it has a very high probability of winning, resulting in actually decent win rates. This is one of the reasons it's one of my favorite ways to trade. One of my favorite strategies to trade is because it's not predictive. It shows me something that is currently happening in the market. And those of you that's known me for more than 5 minutes will know that I always say it's impossible to predict what the market is going to do, but it's fairly easy to follow what the market is doing. And that is the reason I like divergence, because it shows me something that is happening and I'm just following what's happening, what the charts are telling me is happening. Okay, so guys, I really want to encourage you guys, if there's any questions on timing, or if you feel I didn't explain something properly, please feel free to ask questions in the chat. I do have the chat open, so if there's anything you guys want to ask, go for it. This is a great opportunity to ask questions. We can discuss this immediately or answer them immediately. We might get a hidden divergence set up here. We've got a nice push going upwards. We have price coming down now, and these lows on the stochastic wasn't that low to start off with. They were all roughly 50 or above. So if price does come down to this area now and turns up again, it will be hidden divergence. It's not yet. So I'm not going to take a trade here. I'm going to wait for it to form. But we might see it form here, which will be nice. Okay. Just a reminder, that's your promo code for those of you trading with PO Broker. Divergence 80, and that will give you guys an 80% deposit bonus. Okay. Right, so my stochastic is making new lows. This is confirmed hidden divergence already, or this will be hidden divergence, but now I just need to find a way, find an area to take my entry. So I'm just going to wait for the stochastic to cross upwards. And once it does, I'm going to get in. Oh, this is going to be a 1 minute trade because I'm on a 10-second chart. And this is the reason it's important to wait for those, how can I say, but I kind of want to say for confirmation. I'm going to take a buy here. This should be fine. It is confirmed. And there it goes. Okay, so in any strategy, we do lose trades. Those of you that's been following the channel will know that we don't get excited when we lose a trade. It happens. We accept the loss. You guys will notice that I never martingale. I don't take revenge trades. I don't take, if I lose a trade, I don't take another trade immediately. For me, that is a bad way of trading, and it usually ends up costing a lot of money for the people that does that. It's not a good way of trading. We wait for our trades. We know we're going to lose some trades. We know we're going to win some more trades than we lose usually. There we go. A good trade. Okay, so we had 2 trades in, we're on now for 30 minutes. We've already had 2 divergence trades. One was on 1 minute chart and one was on a 10-second chart. So it gives you an idea of how often you're going to be getting trades on divergence, specifically just divergence, which is also the reason I employ more than one strategy when I'm trading during the day. I don't use divergence only. I do have other strategies that I use. We have discussed some of them in previous videos, and we will be discussing more of them in upcoming videos. But this will give you the idea of the rate at which you're going to be trading on average. Some days, and it does happen, some days I've sat in front of my charts and didn't get a divergence entry for 2 or 3 hours maybe. It happens. And other days, the 10-second chart, for example, will give me 5, oh yes, that's 5 is a bit high, but maybe give me 2 or 3 divergence trades in an hour. So it's never the same. Don't expect it to be the same. It's never at the same time. A lot of people make the mistake as well of thinking they can designate a specific time for trading during the day, sit down and every day do the same amount of trades and the same amount of money and stuff like that. That's never going to be the case, ever. It doesn't work that way. Some days are good for us, some days are bad for us. It's not tied to the days, it's just because the market cycles. So some days, some days your Monday might be slow, you're not getting entries. So you need to be more patient or stop trading. And then maybe sometimes the next Monday will be so nice and you will get entries left and right. It's never the same. Okay, so keep that in mind. It's one of the things I like to remind people of. Trading will never ever be the same at the same time of day. You're not going to get the same amount of entries every day with specific strategies. It doesn't matter what the time is. It doesn't matter what time you trade. It doesn't matter what day you trade. None of these days will be the same. Right? And if you're having a bad Monday, just come back next Monday. It doesn't mean you can't trade on Mondays. It just means your strategies aren't performing well today. It does happen because the market cycles. There's always different conditions. So yeah, don't get flustered. We will lose trades. Just be smart about it. Don't double down on losing trades and don't, get emotional. Just stick to the strategy. It's whatever strategy it is you're using, you just stick to it. And because if you're using it, it works. You've tested it, supposed to anyway. So it's fine. We do lose trades. Okay, so guys, no questions, none whatsoever. Okay. Okay, so we're back up. Okay, let's see if we can find another entry maybe. We actually haven't looked at the 1 minute for a while. Looks like we might have some normal divergence forming here. I doubt though. I don't think it will. This is another great thing. Another great thing about divergence is that although we can't predict the market, we can't predict what price will do, we can see potential divergence setups before they actually form. And that's a major advantage. It gives you time to get ready for the trade, to wait for it to set up. And that's a massive advantage. Quite often, I'll miss, especially when I started trading, I used to miss so many setups because I was all over the place and not paying attention to a lot of stuff. But once you get the hang of divergence, you can actually start to see it. You can see where it might form. Okay, it doesn't mean we trade, we take the trades before it forms. You always have to wait for divergence to form first, but you can identify areas where you might get where divergence might be forming before it actually forms. For example, if we're moving in an upwards direction, if you guys, those that were watching, will remember that I spotted this buy we had here way before it actually finished forming. So I could see that the conditions for divergence was getting met. Wasn't quite met yet, but I could see that it's busy forming, and I know that if price started pushing back, then it would have formed. So I knew I had to pay just a little bit of extra attention so that I don't miss my entry, and get in at a bad spot or miss the trade completely. So that's one of the nice things as well about divergence. You can with a little bit of practice, you can start to see it form before it actually does. It doesn't mean it will always form. So please don't get into the habit of thinking it's going to form and start taking, and then taking trades before it has formed. Quite oftentimes, I will see that it's being set up, but it just never forms. It just never makes divergence. And if I were to take trades before, it would have ended in bad results. So we always wait for it to form, but it is a way of, once you're used to it, you can actually start seeing it form before it confirms and before we go. Now this looks like a sell trade. It's very faint normal divergence. We had the high here, price pushed back, came down a bit, pushed up again, and my oscillators, the stochastic made a lower low, as did the RSI. This is too late for me to take now, but this is an example of normal bearish divergence. So we could have taken a sell trade up here. This would have been, that would have been the candle to trade. Would have been there. But it's super faint. It's super faint. It's really close. So you can't, it's not properly distinguishable like this trade we had here. Again, we had, this was a well-defined low. The stochastic was flowing. It wasn't caught in an area like here. We did have prominent or distinctive lows in the movement of both the oscillator and the price. I prefer to when it's flowing like that, but this would have been a good trade. If we caught it early, we would have had a winning trade on our hands. This is 10 seconds, so it would have been a 1 minute expiry. But it's fine. I really don't mind missing trades. If I'm not comfortable with the setup, I'll just leave it and wait for the next one. There's no rush for me. It doesn't matter how much time I have to trade. If I usually trade my local time, which is it's almost 3 o'clock here in the afternoon. So I usually kick off with the UK session, and then I usually trade 5 or 6 hours with breaks in between. That's my normal trading day. But even if I just had an hour, maybe, it's still not advisable to rush your trades. You have to sit and wait patiently wait for entries, nice entries, or not nice. Nice is a bad word. Sorry. Properly defined entries according to whatever strategy you're using. Okay, so it needs to be clear before you get in. We don't just jump into anything that looks like it might be forming, or might be going up, or might be going down. Okay. All right, guys, I think we had two nice trades. We had them on different time frames as well. So we covered that. We covered the expiry times. Like I said in the beginning, remember, we need to give a couple of candles for divergence to play out. So if you're watching a 1 minute chart, if you find some divergence, take a 3 or 5 minute expiry trade. And if you want to do 1 minute expiries, maybe watch a 10-second chart, because divergence needs a few candles to play out. It doesn't. I will never try to trade divergence on a single candle. Okay, so and we covered that divergence works on all time frames, or you will find it at all time frames. Needless to say, the higher your time frame, the longer it's going to take for you to find entries. So if you're using a 1 minute chart, you're going to get fewer entries than if you were using a 10-second chart. If you're using a 5 minute chart, you will get fewer entries than when you're using a 1 minute chart. So as your time frame goes up, you will get fewer entries, but you will find it on all time frames. Okay, so remember, and also we said you can use any oscillating indicator. So anything that moves between 2 points, 0 and a 100, for example, as the stochastic and the RSI does, or you can use something that oscillates between around a 0 point, like the CCI, Williams percentage R. You can use that. You can use the MACD. All of these things will show you divergence. So you can use whatever. Or if you're using something, a different oscillator already for a different strategy, you don't need to add indicators. You can keep using, if you're using the CCI, for example, for a different strategy, you can use the CCI to find divergence as well. You don't have to use the stochastic and the RSI. These are just my personal favorites. I prefer using these, and but you can use whatever indicator you want, as long as it either moves between two set values or moves around a 0 line. Okay, so yes, I think that's that for today. Are there any questions on divergence? Anything before we close off? Anything that I explained maybe didn't explain properly or clearly? I'll give that a few seconds. Let's remove that line. None from the chats. Okay, guys, so one last time, those of you training with PO Broker, there's a code for you guys for an 80% deposit bonus from as little as $10. So no limit on or no restrictions on the amount. You can just make a deposit, and if you need to make use of that, you can use that code. Thank you for watching, and I will see you guys on later this week. Let's not fix a date yet, but I will see you guys again later this week. And until then, guys, as always, trade safe, trade smart, and thanks for watching. Cheers.